everyone. Welcome to the Real Estate Private Equity Show. I'm your host, Ava Vanasaki, and I'm joined by my co-host, August Vinyaz. We are excited today, guys. We're switching things up. We have an industrial guy on our show. But before we get into that, please like and subscribe as it helps us build our channel and allows us to keep bringing you great content, great expert guest speakers. And of course, our mission is to empower investors to earn passive income through real estate investing.
Absolutely. Yeah. And this show is obviously not monetized in any way. So all we ask is to like and subscribe and share it, get the content out there, because we're hard at work finding the best guests for the show to increase your knowledge about the real estate sector, about the best investments possible. So
Absolutely.
all we ask is like and subscribe. So we're really excited to have our guest on today. And coincidentally, what happened is just a few weeks ago, a report was published by Marcus and Millichap about the industrial asset class, which beat every other asset class.
Yeah, that blew me out of the water.
Multifamily, our asset class, retail, and the S&P 500. So
Wow.
We're excited to have our guest on and get right into all of those details and get a crash course on industrial asset class and see what is all up to there. So
yeah, I can't wait. And Chad, I'm going to do a little introduction because the man himself is going to give us that crash course. But let me tell you guys a little bit about Chad. Chad has worked as an industrial real estate broker since 2005. And as a member of the global commercial real estate company and a partner with his local firm, Chad has completed over 500 deals with clients ranging from small companies to large institutional owners. In addition to being the host of the Industrial Real Estate Show, Chad is honored to have been a guest on over 20 other real estate podcasts, as well as being
21.
Yeah, 21 now. And as well as being interviewed numerous times by national media. Chad earned both SIOR and CCIM designations. He can tell us all about that, and an MBA, and is proud to have been recently named as an industrial influencer by globestreet.com.
We love Globe Street. We get a lot of content from there. We send that content to our investor community as well.
Yeah, every single week. Now, we believe this interview with Chad, guys, is going to bring great value to both passive and active investors looking to learn more about the industrial asset class and why this asset class has been the best performing asset class over the last 20 years, beating the S&P 500. Thanks for being here, Chad. Welcome to our show.
Yeah, thank you so much for having me on. I'm fans of both of you guys, so it's an absolute honor to be on the show. I love talking about industrial real estate, and I always like to say that no questions off topic. I am happy to answer any question you throw at me regarding it.
Amazing.
Fantastic. Let's start off by, you telling us about your background and your start in real estate, please.
Yeah, a great place to start. So I actually got into residential real estate first. I had bought and sold a few houses with some friends, really saw an opportunity to get into that as a career. So in 2004, I got licensed and joined a residential real estate brokerage. Quickly discovered that just wasn't what I wanted to do long term. So I started pursuing the commercial real estate route. 2005 is when I got introduced to a few different brokerages. The one that I ended up getting a job with, getting hired in 2005, still actually at that company today. So we're coming on 17 years now that I've been at the same brokerage. At the time, I didn't know much about what industrial real estate was. I thought commercial real estate was big office towers or shopping malls, more of that glamorous aspect of commercial real estate. And it just so happened that the brokerage that I ended up joining was heavily focused in industrial. So I like to think that I stumbled into industrial real estate. And like a lot of people, perhaps even people listening on this episode, they might not have a really good understanding of what industrial real estate is either. So I'm happy to share like how I started gaining knowledge, gaining experience with it. I started investing in it myself in 2014.
That's basically our next question. We were hoping that you can give us a crash course on the industrial asset class. And what does industrial entail, and who are the players in this space? And by players, we mean investors, institutional, retail. Who's buying it? So tell us all about it, please.
Yeah, great question. So it's evolved considerably over the last 2 decades. And in that report that Marcus and Millichap would have put out about it being the best performing asset class, even over that last 20 years, industrial's gone from being this obscure asset class that a lot of people don't know to now everybody's familiar with an Amazon distribution center. In Vancouver, you guys would have a ton of industrial going up in high profile areas now. Whereas before, industrial was largely tucked away outside of the public purview for good reason, right? The public planners didn't want to have a large industrial facility that was manufacturing something right next to a bunch of houses. So it was specifically tucked away out of an industrial park. Now we see massive industrial facilities on major highways, close to airports. And with that, people just seem to be a little bit more familiar with supply chain and all of the supply chain disruptions we've heard over the last 2 years, and vacancy rates being really low. I actually heard in some of the port cities like Vancouver and LA, the vacancy rates are under 1%. So I like to break industrial real estate into three subcategories. First would be the warehousing, and that's what most people are familiar with now. Those are the big buildings where there's racks of storage. Things basically come in, it's sorted, it might be stored for some period of time, and then it gets sent out. And to familiarize people with that, everybody actually knows about a warehouse because they've been in one, such as a Costco or Home Depot. These are really just large warehouses that have racks of storage. Customers come and pick stuff up and they take it out. It's in a retail location, but it really is just a warehouse. So that's the warehousing section. And that's what's come into the public knowledge a lot more specific in the recent years. The other major one would be manufacturing, and this is where where things are just made. It can be raw materials coming into the building. It's assembled, manufactured, produced. There's something that happens to that raw or semi-raw material, gets converted into the finished product, and then it gets sent out. An example I always give for a manufacturing facility is not far from you guys. It's the Boeing factory in Everett, just outside of Seattle. It's a 4 million square foot building, and most people can't even wrap their heads around just how large 4 million square feet is under a single roof. But if you think of the average house being 2,000 to 3,000 square feet, you start getting appreciation for just how large this building is. But essentially, it's all the raw products that come in that goes into manufacturing the airplanes. It's produced, it's assembled, there's some manufacturing that happens there. Then the airplane goes out the door to the end customer. That manufacturing side is still a massive component of the industrial real estate space, but most people don't see that because it's out of the public view. It's tucked away in these industrial parks, but that makes up a huge portion of the industrial market. And then the third one is a little bit of a catch-all. So you could almost call it a miscellaneous group. The industry typically will call it flex properties. So flex properties are typically going to be all the properties that are zoned industrial that aren't necessarily compatible for either manufacturing or warehousing. And there's tons of examples. You might see churches in industrial zoning, self-storage, car dealerships is another one, because there'll be a showroom at the front where they have their cars, but at the back will be the garage where they physically work on the cars that need repairs. And we actually, one building that we own, we have a full office tenant in it. It's an industrial zone building in an industrial park, and it's a full office tenant that's in there. So that flex property is kind of meant to catch all the other properties that could be used for manufacturing or warehousing, but they'll typically be used for other non-conventional uses.
Great. And I guess the next question here is more about your opinion, but we'll love to hear it. Just like we talked about, John Chang from Marcus and Millichap discussed about, kind of had this, the report, and I can kind of share it over here, but it talks about how industrial, over the last 20 years, beat the S&P 500, beat multifamily, our asset class, and other asset classes. I'll share my screen here quickly. So as you can see here, so I guess the question to you is, in your opinion, if you have any data to back it or not, why do you believe industrial was the winner? What was the reasoning behind that over the last 20 years? And this is not short term over COVID or something else that happened. This is 20 years. So talk to us about that.
Well, I think the easiest answer to that, and if you were, you wouldn't have it available to you right now, but if you were to overlay e-commerce sales and how e-commerce has grown, that would be a 20-year trajectory. The e-commerce really started in the late 90s, but it didn't start getting significant traction until the early 2000s, which coincidentally is right when you see that graph start. It took a good 10 years before e-commerce started hitting a critical mass where they were really starting to eat more market share from the traditional brick and mortar retailers. But once it did, you could see that kind of hockey stick curve where coincidentally you start looking at COVID where
if you see the graph, that graph was still on its way up before that the hockey stick kind of increased. So it's even though it's double the retail, the next in line, you can see that the trajectory was there to beat the other asset classes as well. But please keep going.
Mm-hmm.
Yeah, and that's e-commerce. I was buying stuff online myself, dating back that far. Not probably not in the early 2000s, but in 2008, 2009, I was buying things online, and that's what contributed significantly to the industrial asset class performing so well. Is that all this e-commerce requires a considerable amount of warehouse space along the supply chain. So there's markets all over the world which had to increase their warehouse capacity to handle the demand, and that demand was all fueled. You could call it the Amazon effect. Amazon was the main driving force, but they were far from the only ones. There's a lot of retailers that have started e-commerce divisions, Walmart being another big one, Costco being another big one. All these products are stored in warehouses in various locations, and often they're stored in multiple locations. A product that might come from overseas in China that lands at a port on either of the coasts and then gets shipped in by truck or rail, that product might see the time in 4 to 5 different warehouses before it actually meets the end consumer. So that supply chain required a tremendous amount of industrial space. And where you really see that exponential growth was with COVID. And it's we're all familiar with how the pandemic physically forced some retailers to shut down, where they couldn't even be open. Well, that all of a sudden said to people that were perhaps resistant to shopping online, that now forced their hand, where that was the only way that they could get things. So it changed a lot of patterns. People that before were reticent to start shopping online had no other choice. And when that boom came of people ordering so much stuff online, it required that much more industrial space. There was that much more demand. In some hot markets right now, the vacancy rate for industrial is under 2%, and in some ultra hot markets, it's under 1%. Which, when you get to that level, there's very essentially zero vacancy. There's just pockets here and there that come up. But that it goes to speak to, if you have a market where you're getting that low of vacancy rate and you have a corresponding increase in rental rates just as a reflection of the low vacancy rates, that makes the returns look pretty compelling. So I'd say as a whole, the market has been a very unsexy, tucked away, steady asset class for many years before this, for decades, really. And a lot of institutional investors were skeptical of it. They didn't see the big returns compared to the more glamorous office or retail properties. But now, when you see so much demand picking up for an asset class, and you see that being relatively stable as these consumer patterns are probably changed permanently, at least to some extent, then it all of a sudden becomes that much more of an attractive asset class. And that's why we've seen a lot more institutional money flock into it.
And we got some more questions later on about the institutional money coming into it. So great, let's get to our
I have a question for you, Chad, and I'm just curious. Could you describe to us what an anchor tenant is? And is it fair to say that the more tenants an industrial site has, the less risk is associated with vacancies?
Yeah, it's actually a topic where there's a lot of debate on. So it's a really great question, and I've had people on both sides of the story talk about what they prefer. But to answer the first part of your question, an anchor tenant is it's actually pretty common in retail, where it'll be like a grocery store in a neighborhood shopping center. That grocery store will be considered the anchor tenant because the customers that come into the grocery store drive some ancillary traffic and business to the smaller retailers. But in industrial, it can be common as well, where you might see a million square foot building where one large tenant takes up 300,000 square feet of it. And that could be the anchor tenant in there. You might see a building where we have one in our market as an example. Amazon has a million square foot building, and it's just their building. They're the only ones that are in that building. It's interesting on how there's different perspectives on this, because I would have thought as well when I first started in the career that having multi-tenant would be better, because you can diversify your risk. If you have 10 tenants in a building using an arbitrary number and one leaves and you have a hard time filling it, in theory, you've only lost 10% of your income, versus if you have one tenant and that tenant leaves, you just lost effectively 100% of your income. But what a lot of industrial investors, particularly larger ones or really sophisticated ones, think is that it's much easier to manage one tenant versus managing 10 tenants. So they look at it from the perspective that they can scale their business much easier than if they could add one building that's worth $100 million versus adding 10 buildings that are worth $1 million each. My math was right on that. My math was wrong. I think you get the point, is on how they look at it from the standpoint that it's just easier to scale. So it's funny. The properties that I own, I only have one that has a single tenant in it, but everything else is multi-tenant. But I don't have big institutional pockets where if my tenants all left, I can't afford to float it forever. So I like the idea of having multi-tenants as well. But I think you can appreciate, if you were to compare an industrial building to a multifamily building, and let's just say an arbitrary $5 million building, you could get a $5 million industrial building with one single tenant in it. But if you had to get a $5 million multifamily property, you might have 20 to 30 tenants in there. And from a management perspective, without getting too much into the nuts and bolts of it right now, which we certainly can later, it's just a lot easier to manage one tenant where they take care of everything themselves versus 20 to 30 residential tenants who have demands and needs, and you're constantly turning things over. I think that's one of the biggest reasons that investors would say they like single tenants better. But I don't know if there's a right or wrong answer to it. I think it really just does depend on the investor's preference and risk profile.
Got it.
Yeah,
Now,
well
focusing on the tenant and these kind of one tenant or main tenant, mainly big institutions. You talked about Costco, you talked about Home Depot, we're talking about Amazon and other, large institutions, or large businesses that are in need of, industrial building. Now, we know that the McDonald's, McDonald's restaurant business model, which was being in the business of purchasing land and then leasing it back to their franchisees. And now, why aren't large groups like Amazon purchasing their own land and building their own industrial warehouses? Because also the kind of putting up an industrial building, looking at it as far as the work that goes into it, comparing it to a multifamily or a high rise or other types of structures, is much easier to put up. Is there a trend where these large companies are building their own, purchasing their own land, building their own, the buildings, or why should there even a market exist for tenants when they have enough capital to go and build their own buildings?
Yeah, that's a great question. It comes up all the time from investors who are worried that they won't be able to find tenants, and it comes up from smaller companies that wonder why they would want to lease when they can own something. And the comment I'm sure you've heard as well is tenants always think they're flushing their money down the toilet when they're renting. Interestingly, Amazon's one of the world's largest occupiers of warehouse space as a tenant. They rent the vast majority of space that they have, although they are starting to do some more stuff with their own capital to invest in it. But why would one of the world's top companies with a lot of cash on reserves, why would they rent property instead? It really comes down to how they look at what return they would make on their money. So if they were to buy their own property or buy land and develop their own property, they would do some sort of projection on what they could expect to earn on that money over a 10 or 20-year holding pattern. And they would basically be evaluating it from a real estate investment standpoint. Conversely, they would say, if we took that money that we would have invested into the real estate and invested it in the company, so maybe it's adding a new product line, maybe it's adding more inventory, maybe it's expanding into another market, can they earn a higher return growing the company with those resources than they would earn on the real estate? As a shareholder of Amazon, I simply want them to maximize every dollar of investment that they have. I don't care if that's in real estate. I don't care if it's adding another product line. I want them to maximize their return. And for the most part, companies should be able to earn a higher return inside of their company, whether it's more inventory or new locations or expansion. They should be. Otherwise, they should just get into the real estate business if they can earn better returns on that, because they're stewards for financial capital, mine and millions of other shareholders out there. So that's the main reason that companies won't, is they just have determined that they can make a better return growing their company as opposed to growing a real estate portfolio. And that's great for the real estate investment community, because then if you're an investor, and I don't have companies anywhere nearly as large as Amazon in my portfolio, but there are a lot of sophisticated and institutional owners that do, you've got a really captive tenant that is invested in that space and wants to rent there because they've just determined that that's the best thing to do for their business.
A great answer. You must
Awesome.
have had some experience on that answer
Learn
posting in the
something new
past.
today.
That comes up often. Like it
Yeah.
really is a great question. I hear that question all the time, and it really is and that's why people wonder. It's a natural question. If you're Amazon and you've got, I don't know what their balance sheet looks like right now, but I'm assuming they've got billions of dollars of cash sitting there. It's a natural question to say, why would they have that cash sitting in a bank account when they could go and own their real estate? It's a great question to ask, but that's usually why it is.
Got it. And long
Very
term, I
well.
mean, if I was advising them, I would say long term, buy land, build your own buildings, particularly when it comes to close to airports, where you know that airport is going to be there for the next 100 years or even more. So,
For sure.
but yeah, let's continue the conversation. Let's talk about this concept, the loss to lease, that we were very familiar with in multifamily. And just to define loss to lease is the spread between the market rent and the current rent the asset is generating. So now I got to describe between multiple asset classes here. So we're talking about hospitality, multifamily, and industrial. So kind of let's differentiate those three. So in a hospitality asset, the loss to lease is really non-existent because your prices fluctuate and change daily. So if there's an event in a town, there's people coming in, you increase, there's a lot of demand, low vacancies, you increase your rates for hotel rooms. Or even short-term rentals, any kind of hospitality. So you're able to change those rates on a daily basis. In multifamily, in the regions we invest in, they're very landlord-friendly regions, the red states, the Sun Belt states in the US, and it allows us to change those rents annually. To either increase the rents or to not renew the lease. That's not possible really here, most places in Canada, because the strict rent control laws. So that's annually, it changes that. Now, on the industrial side, we talked about, I'm not sure if we're labeling it correctly. Is it called an anchor tenant in industrial as well, just as it is in retail?
I don't know if you certainly could. I don't think there's anything wrong with calling it an anchor tenant. I think you could even just call it a tenant for simplicity, whether it's a big, like a AAA tenant, or whether it's a small local mom and pop shop. I probably wouldn't differentiate it in my market anyways, but there certainly could be markets out there that do call them anchor tenants.
Got it. So let's say a primary tenant, you got the primary tenant is a large corporation that has their, is renting the space from you. Most times these contracts are a 5-year contract, and correct me if I'm wrong, or a 10-year contract, and they're triple net, and we can kind of discuss what triple net is. But how do investors or property owners or landlords mitigate the fact that rents could go up exponentially, but now they're in contract with the tenant for a long-term contract? How do they mitigate that loss to lease? Educate us about this topic, please.
Yeah, I love this question. I think this is such a great question. So perhaps we could start with defining a triple net lease, because if for people that haven't explored commercial, it might be a bit of a foreign topic for them. But for most commercial leasing, and this would extend to office, retail, and industrial, you'll see triple net leasing. And to explain it as without getting into too much detail, but just at a high level, you'll typically see two types of rent paid from a tenant to a landlord. The first is going to be the base or the net rent, and this will be a contractually agreed upon rate for the duration of the lease. So it could be a flat fee. Most rates are quoted on a per square foot basis, unlike residential, which will typically just be quoted as an amount per month. It'll be on a per square foot basis. The base rent and the net rent will be contractually agreed upon for the whole term of the lease. So it could be $10 a square foot for every year. It could be $10 a square foot with escalations. So maybe there's a 50 cent a year escalation so that it ends at X amount after year 10. But that amount is agreed to, and that gets paid to the landlord regardless. There's also an additional rent, or operating costs, as it's sometimes called. Different markets treat it differently, so the terminology might vary. But the whole intent with that is that there's operating level expenses of the building. Generally, that's property taxes, building insurance, common area maintenance like landscaping or snow removal, and management fees. Those are the operating level of expenses which are required to just keep that building functional. Those costs all flow through to the tenant, and it's usually provided as an estimate. So at the beginning of this year, 2022, the landlord would make a budget and say, this is what we expect property taxes, insurance, common area maintenance, and management fees to be. And they'll do that on a 1/12 basis, so that the tenant's paying those expenses a budgeted amount every month for the whole year. At the end of the year, the landlord reconciles all the bills, determines what the actual cost was. They'll either give a credit to the tenant if they overcharged, or they'll invoice them if they undercharged. So that amount flows through. So if property taxes go up in year 3 and they go up 20%, those property taxes flow right through to the tenant. And that is a key thing to keep from eroding that contract rent from the landlord. You can appreciate if a residential landlord leased out a space to a tenant for 10 years and it was just a gross amount, they charge the same amount for the whole term. At the year 3 or 4, their property taxes, especially with what we've seen in property taxes lately, that could completely erode all the amount of money that they have coming in. So the beauty of commercial leasing, particularly industrial, as we're talking about right now, is that you've got the ability to flow through any expenses. That's the nature of a triple net lease. In your question about that loss to lease scenario is excellent to ask, because that is a very sensitive topic right now in a lot of these hot markets.
Inflation, that's
Huge.
a huge part of it, right?
Huge. Yeah. There are some leases that will tie the base rent, they'll tie it to CPI increases. So the lease rate might say it's $10 a square foot. That base rent might say it's $10 a square foot plus CPI increases. That's a very common conversation that's happening right now, because we saw inflation going up. We're 6.5% in Canada, you're 8% in the US. That's a huge discussion. I think it's worth looking at it though as well, that there's the corollary of perhaps undercharging a tenant for a market that's really hot. There's the opposite, where you could be overcharging a tenant in a market that's cool. And I'm in a market that had heavy oil and gas exposure for all that manufacturing side, which the last 6 years haven't been overly kind to. It's improving now, but we were in a provincial recession for 6 years. All those leases that were in there could conceivably have been less than what the landlord was charging from a market standpoint, but they were contractually obligated to it. So it's a blessing and a curse from the standpoint that you're a landlord just trying to get a fair market rate, but you're locking in your lease term for a long term. And like you said, 5 to 10 year leases in industrial isn't uncommon at all.
But what is an Amazon lease? Is it a 5 year? Is it a 10 year? If you had a building and you were going to lease it to Amazon, what is the industry standard term?
They'd be doing anywhere from 10 to 15 years.
Wow. Okay.
Yeah. And if there's one going up in our market, which has a whole bunch of robotics going into it. I'm not privy to what that one is, but I wouldn't be surprised if that was even a 20-year lease, just because of how capital intensive it is to get everything in there and get it built specifically for them. It's a multi-story industrial building, lots of robotics. If Amazon were to leave, it'd be very difficult to find another tenant for it. So I wouldn't be surprised if they did 20 years or even longer.
Yeah, I see the need from the corporation side, the Amazon side, the Amazon's side of things. They're literally part of the supply chain, so they want to be in that location long term. I see the need there, but now pre-inflation and the potential recession that's coming up here, pre this situation, were investors and landlords taking into account inflation, which was historically at like 2.5%? Was that a part of the calculations they were doing when they were signing a 5-year, 10-year, 15-year lease, or has that now they're increasing that amount, or how does that calculation work?
There are very few investors that I've talked to that had the foresight to expect this type of inflation. Even though looking back on it, it should have been pretty obvious with how much money that they printed. There weren't many landlords that forward thinking. So they might take it into account without direct consideration for it. They might say, well, let's get, and I'm just using arbitrary numbers again, let's say we get $10 a square foot. If we can get 25 cents a year escalation, well, that's 2.5% a year. So we're kind of keeping pace, at least with the federal bank's guidance on what they have. So that was pretty common. I didn't see many leases structured from 2021 and before that actually tied it to CPI. That's coming in quite frequently now. There's a lot of landlords trying to insert that language, but that it didn't exist it wasn't prevalent before this year.
Is it fair to say on that logic that there's a lot of loss of lease currently in this space, that the returns have beat every other asset class? So could those numbers have even been much higher because the rents are not at market currently on many of these properties across Canada and the US?
Absolutely. There's tenants that are going to be coming off longer term leases. They're in year 9 of a 10-year lease. When their lease comes up next year, they're going to see a considerable bump in their rent, and it's going to hurt. So you're right. I think if there wasn't this tendency to sign longer term leases like 5 to 10 years, I think we would have even see more inflation just as a result of landlords trying to ask more rent than the companies that have to pay that rent charging the end customer more. So I agree. I think that this inflationary problem is problematic, and that's why the feds are trying to do it. The U.S. just set another 50 basis points today. So I think that they're behind the 8 ball on this. I think that they're trying to play catch up, and it's a lot of turmoil in the market right now. It's hard to even predict what's going to happen right now.
Yeah, absolutely. A lot of people are
following it every single day. What's going on now?
Yeah.
we're sitting on the sidelines. We've got some great deals coming across our desk, but we're sitting on the sidelines here, very cognizant of what's happening with the markets.
Ready to play offense and defense at the same time.
Mm-hmm. Absolutely. All right. Would you like to ask this next question since I stole a couple of your questions, Ava?
Yeah, absolutely, Chad. Let's discuss industrial long-term. Tell us the good, the bad, and the ugly. And we asked the ugly because of what happened to the office space as an asset class that no one expected to be underperforming. So let's kind of
talk to us about long-term. I mean, it's all great what's happening, but with technology and things changing up, what is your view long-term about this industrial asset class and where it's going and what's happening?
Yeah, long term, I think it'll stabilize and normalize to be more just in line with inflation in general. What's the driving factor behind warehouse space and the need for warehouse space is consumer spending. If people stopped spending money on consumer goods, we'd have much less of a need for warehousing space. So to a large extension, we will move somewhat lock and step with the market as a whole. In the short term, I think that there's still going to be a lot of problems in the supply chain with just the shortage. And in some of the markets like you're in, or LA or New York, they've got physical land constraints where they can't even add new inventory. So that's where you'll start seeing multi-story industrial properties go up. You'll see prices continue to escalate. In other markets where vacancy rates are more normal, it will be interesting to see how that responds to any potential dip in the economy. And I never want to predict a recession, but there's a lot to think that a recession's on the horizon. The 2 and 10-year treasuries flipped. That's usually been a historically pretty accurate indicator for a recession. And I had this conversation with someone the other day. I don't think a recession is necessarily a bad thing. It gets a lot of negative news publicity, but it's really just 2 quarters of negative GDP growth. So you're talking 6 months really of an economic pullback. It doesn't need to be dire. It just needs to be negative GDP growth. And that might not be a bad thing with how inflated we've been over these past 2 years, where it just seems like it seems like a real fake economy in my mind, where there's a lot of government spending, a lot of government programs. I was leery at how this was all going to play out in the end, and it looks like it's just playing out by that cycle of inflation goes up and the feds have to increase interest rates, and then you see some sort of economic pullback, and then it repeats itself. I think that cycle will probably continue indefinitely, really. So I don't know what's going to happen in the medium term, other than there's chronically low vacancy and it's taken a while to get new supply onto the market. So in the next year, providing there isn't an outright depression, I think that it's too difficult to get new product on the market, and there's just so low vacancy rate. I think the market's still going to do quite well in the next year to two. Then they'll start trailing off as more inventory just gets added, because that's what happens every time there's a boom, is that developers see an opportunity. Then I decide I'm going to develop something, and someone else decides, and then we all decide, and nobody's really talking about and coordinating with it. And then there's all this new inventory that comes on the market. And at some point, e-commerce sales are going to have to taper off, because there's only one pie. There's one pie of economic spending that people spend all their money on, and bricks and mortar retailers equals a big portion of that, and e-commerce equals a growing share of that, but it can only grow so much. Like I'm sure it's the same with you guys. I still love going to stores, right? If you're looking to buy a suit jacket, or you want to buy shoes,
Costco.
or you want to
Costco ritual,
Absolutely. Or you want to go to a restaurant, which is in a retail space. Like there's always going to be a need for physical brick and mortar retail space. So e-commerce sales it will have to taper off. There's no question about it. Whether that's 5 years out, 20 years out, how much of that share can actually grow. I think that there will be a leveling out at that, and the pace of industrial construction won't level out at the same amount. We'll overbuild, I guess is what I'd say in a roundabout way. We'll have too much industrial inventory at some point in the future, and there just won't be enough demand to pay for it. So it'll be somewhat of a reversal. You'll see increased vacancy rates, and you'll see lowering rental rates. That'd be my best guess for what would happen 20 years out. But I also don't think that's necessarily a bad thing for an investor that's looking to have for 20 years, because we're in such an inflated market right now. Nobody can build their pro forma off double digit in growth for multiple years. That's just nonsense to even think that you could do that. But if you had steady growth, if you're just keeping pace with inflation, and you're managing an asset responsibly, and you're paying down debt, and you're keeping your tenants happy, and you can keep that property, maximizing it for the best case of what the market conditions are, I think real estate is still an unbeatable investment vehicle. But it's just realizing that there's going to be a lot of cyclical pressure on that and uncertainty for the next 10 to 20 years.
Absolutely. One more last item here. Earlier, you dissected the asset class into 3 categories, and manufacturing was one of those. So now let's talk about the Achilles heel of the industrial space, particularly the manufacturing sector. With manufacturing jobs over the last 20 years moving to China, it's still shocking to see industrial number one. But as that continues, inflation is one of those main reasons where jobs go overseas and manufacturing facilities shut down. Do you see any concerns there as far as the need for manufacturing facilities and that type of real estate?
So I'm going to throw something wild out there, and if this is too controversial, you can just edit this out. But I hope that this makes some sense. I think we should, as a society, actually be making a case for deglobalization. And I say that because there's some things that we certainly need to make in other countries, like computer technology. We just don't have the actual resources to address that. But there's a lot of things that we could easily make in North America that we're instead having made in country with substandard environmental regulations and almost a disregard for the environment, with agenda for profit first. We're having something made in these countries that is literally shipped across the world in a cargo ship, which is not environmentally friendly from a fuel consumption standpoint. Then it's shipped from a pickup truck or a semi truck to another warehouse. It's stored in a warehouse. It's shipped by train. Then it gets shipped by another truck. And that whole supply chain, just to get a product that we could easily make in North America, does not seem very environmentally friendly to me. And I'm a big capitalist. Like, I love profit. I chase profit. I love profit. I celebrate anybody that figures out how to make profit. But all these companies right now, especially the big companies, have a heavy focus on ESG, that environmental social governance, and they're all trying to find ways to be environmentally friendly and be more sustainable. Well, they've got to take a hard look at themselves on whether they're just virtue signaling, or whether they can actually accept that they can take less profit and have things made in North America and not have that same environmental burden that's involved with shipping it all across the world. So I'm not privy to any of the conversations that these guys are having, but ESG is a dominant conversation with these big publicly traded companies. And it seems to me that it's empty talk if they are just prioritizing profit over having some of these easy things to make, like toilet paper or textiles or anything that we just use on a day-to-day basis, which isn't complicated. To ship that all the way across the world is goes against this ESG mantra. And I'm agnostic on whether ESG is what they should be talking about or whether they shouldn't be. I'm not smart enough to have that conversation, but I know that they're having it. And if they're not prepared to acknowledge all the environmental risk that comes with that, then I think it's just a lot of empty virtue signaling. So I would be a big proponent in deglobalization from the standpoint that certain things should be made in the same continent that it's consumed. We could easily make things in Mexico if they still want access to less expensive labor. Though there's going to be a new rail line. CP is merging with Kansas City Southern, and that's going to create a single line railroad that will that will connect Mexico, US, and Canada, single line railroad. There's no reason that we can't manufacture things, reshore it back to North America, manufacture it in states that have low labor or in Mexico, and then have that distributed without having to have the cargo ship and lower environmental standards that it's even being made in the first place in China. I think that there's really an opportunity to reshore a lot of this stuff, which would be great for the North American economy. It'd be great for the environment. It would have long-term effect of just helping our continent being that much more sustainable. And it goes in line with what a lot of these big corporations are preaching right now with ESG. So long-winded answer, but I agree that the trajectory has been taking manufacturing out of North America, and that's just feeding our desire to have cheaply made goods at a cheap price. I think we should really be looking to have much more stuff made in the same place as we're consuming it.
Absolutely. And unfortunately, the government itself, Canadian government and the US government, they're so inclined to make it even harder for manufacturing as far as the jobs and unions and many other items there. They have so many restrictions and the taxes they pay. And I was talking to a friend of mine who's a factory worker who operates a machine, and he was talking about how they're restricted to only be open 5 days a week and all these other restrictions that exist. It's a cardboard manufacturing company that he works in, and just talking like that's not very pro business. That goes against everything we believe in. No wonder companies are going overseas. But great conversation.
Yeah,
all right,
great conversation. Back to industrial, because I really want to. I'm very curious about this, and as we discussed earlier, let's chat about the investors of an industrial asset class. Who buys industrial and why? And moreover, are syndicated investments in the industrial space as common as multifamily? Because in multifamily, we syndicate all of our investments essentially.
Yeah, just to add to that question a bit is like we are very familiar with the multifamily space. We know who's buying these multifamily assets, and we're talking about on the institutional multifamily assets. So large 100 plus, 200 plus unit multifamily assets. They're purchased by REITs. They're purchased by large funds, large institutions, pension funds. They're also then purchased by publicly traded companies as well, but they're also purchased by these syndications, these groups like us who come together and buy an institutional asset, but they do it through syndication, which allows a general partner to bring on, retail investors who own fractional ownership in this space. So the question is, who is buying industrial? And also, follow-up question is, are you seeing the syndication model being utilized within this space?
Great question. So to start, I'd say there's a full spectrum of buyers. And I'm a good example of the far one end, where first property I bought was a small industrial condo, which was $400,000. So it was kind of like the price of an average house of our market. Then you can go all the way up to, there was a huge sale in the US last year. It was a single building leased to Amazon that sold for $247 million. So full spectrum, all the way down from a small guy like me, all the way up to, it was actually the Mormon church, interestingly, that was behind the purchase of that big building. But full spectrum, you can have big institutional players like real estate investment trusts, pension funds, these large buyers that buy at scale, all the way down to small local investors. On the syndicate side, that one's intriguing to me because I haven't seen much on the industrial side. There's one firm called Artisan Industrial, which is doing it, and they're having some success. And I know that there's some other ones spread out in different markets, but it's surprising actually that more people haven't looked at that as an opportunity to pool some money, be the GP, find the deals, organize them, bring in some limited partners. I'm actually surprised. And maybe there's somebody out there listening that can spearhead that and get in on it, because there's very few people doing that. It usually seems that it's a couple partners or a small investor like myself or big companies that are doing it. I haven't seen a whole lot on the syndication side.
Well, as CPI Capital grows, we're looking to get involved in the industrial space, so we'll be chatting.
Yeah, well, you could diversify I'm sure you guys know multifamily very well. If you ever did want to explore another one, I think industrial is a great one to have for a long-term outlook.
Awesome. Absolutely. We'll discuss that. All right. Let's discuss the US. So I did some research on you prior to getting ready for our show today, and I noticed that you speak on a lot of US podcasts, US platforms. You're very familiar with the US, the US and Canada, because you speak to both audiences. So talk to us about, when we discuss industrial asset class. And when we discussed the reports, but Marcus and Millichap is we're talking about the U.S., but obviously I'm assuming that the growth have been similar in Canada and the U.S. So talk to us about the difference between, we know the difference between in multifamily in Canada rather than the US is mainly the rent to value ratios, that cash flow is non-existent in Canada. The cap rates are so compressed, so there is no yield really for us to chase. Appreciation is there, but to have cash flow and appreciation is non-existent. It's difficult to be able to pay your mortgage payment to pay the debt from the rents you collect. But in the US, because of the rent to value ratios, mainly in these red states, the Sunbelt states, not really California and New York. But talk to us about what you've noticed, in your involvement in the space between Canada and the US when it comes to the industrial sector. And is there a particular area that you feel more bullish about? I mean, you definitely have a dog in the race because you're located here in Canada. You're an investor, you're a broker, you're a thought leader in this industrial space here in Canada, but you're also involved in the US. So where are you more bullish about? Tell us about your experience.
Yeah, I really like the Sunbelt states. I closely follow Texas. That's probably the market outside of my own that I follow the most. And I would be very bullish on Texas as a whole right now. Even more specifically, I'm bullish on a market called Corpus Christi, which is incidentally a port city, which will be a major port connecting that rail acquisition that I mentioned earlier. So I think Corpus Christi is going to be a big market to watch. I know someone in Dallas that I said find a deal, and I'm interested. I think that's going to be a big market. I think they're going to have a tremendous amount of boom there. And anywhere those Sunbelt states. I think Florida is another interesting one to watch. If following that trend that industrial is going to grow in direct relation to consumer spending, you can extend that population growth is going to lead to consumer spending increases, which is going to lead to more warehouse need. So I like Florida as well. There's a lot of markets that I like there. I also think that there's some of those, that Rust Belt still has opportunity in it as well. If manufacturing does come back, and not even withstanding my own thoughts on the carbon issue and the ESG, but I think that there's just some demand to reshore manufacturing so that we're not as dependent on bottlenecks in the supply chain. So China right now is locked down. It's very difficult to even get manufacturing capacity from them. Then if it gets on a cargo ship, there's backlogs at the ports to even get the ships there. So it's causing all these delays in supply chain. So if some of these companies say we need to have more of a safety net on this, and they bring back manufacturing, if for no other reason than they just want to avoid these delays, there's a lot of infrastructure and workforce in those Rust Belt areas. So I like the U.S. I think there's some headwinds on the horizon with a potential recession on what that could do in the short term. But I'd be very bullish just on industrial in a number of markets in the U.S. right now. The two that I'd stay away from, I wouldn't invest in New York and I wouldn't invest in California. But that's just me. There's people out there that love those markets, and obviously California is a beautiful state, but I just think that that's been too overbuilt. I think that it's not a non-business friendly government. There's too much taxes. There's very room for it to even continue to grow. That rail expansion that I've mentioned a couple times now, that has the potential to circumvent those markets by stuff coming into a port in southern US or Mexico, so it could avoid a lot of that. And that market is so susceptible to a breakdown that if some of these big businesses leave, whether it's just they're tired of paying taxes or the anti-business government, then the government's going to be forced to collect more taxes from the residents that are already there. And then it creates a really vicious cycle for people there. So those would be the two markets that I have zero interest in investing in either one of those markets. But I'd hate to talk someone out of that, because obviously I'd love to live in LA. I'd love to live in New York. I would be very skeptical putting my own money in there right now.
Awesome.
Right,
Can't
makes
wait
sense.
to book a call with Chad and talk about syndicating some industrial projects together all over the place.
Awesome.
Texas, Alberta, everywhere. All right. Awesome. Hey, really appreciate all your knowledge. It feels really great to have an expert guest on and learn so much. And it's for us, over the last couple of years, we've had close to 100 guests on, and it's always an educational course for us. So really appreciate
Wow, that's
that.
awesome.
Yeah, I told everybody getting into this, Chad's gonna give us the whole spiel on industrial, and you sure did. So thank you so much for just
Well,
being so
great
knowledgeable.
questions. Yeah,
Yeah,
no, I love those questions. I could talk about that all day, so I love those questions.
yeah, you're super
Awesome.
knowledgeable. We really appreciate it. But I'm
Oh,
really
thank you.
excited, Chad, because we want to dive into your brain and go start on the next segment of our show called the 10 Championship Rounds to Financial Freedom. So whatever comes top of mind, I'm going to start off with the first question. Here we go. Who was the most influential person in your life?
Oh, that is a great question. I would say I've had a lot of people that I really looked up to. I don't know if there's one that really jumps to the top, other than I could easily point to a handful of different people that all shaped my life. My parents were great. They were always encouraging and supportive of whatever crazy idea that I had. I had an uncle that was an architect that really helped me early on in my career and still is a good guide for me. The person who introduced me to the commercial real estate business when I was looking, a guy named Jamie Hayward, was an amazing human being. I haven't followed up with him in a while, but I really owe a lot of my success just to him. So I instead of just pointing to one, I think that there's a handful of people easily, and then I could even point to people that I just rely on. My wife is a big source of power for me. So instead of one, I'd say that I've been fortunate to have multiple ones.
That's
All
beautiful.
right, he just saved his behind by mentioning his wife.
I don't
That's
know if she I don't know if she even listens to my podcast. So she's probably like, oh, he's talking about industrial real estate again.
I'd love to share this one with her. Uh, Next question. What is the number one book you'd recommend?
I just finished a really good book called Behemoth, which was the history of the factory, written by a guy named Joshua Freeman. And that one just jumps to mind because it was very topical for me. I love the history of industrial real estate as well. And he's a professor based out of New York. So he came at it from a history professor standpoint. So a layman from my standpoint of being in the industrial real estate space. But it was just really fascinating. He really dove into the labor movement, the industrial real estate revolution, all the different complexities on there. And I think one of the things that just reinforced for me is that there's nothing black and white in this world. Like everything is very nuanced, and there's so much complexity with everything that you can't just take a hard position on one thing, because there could be a polarizing answer on the other end, which is equally powerful. So it's just there's so much complexity in the world that you really just have to stop and appreciate how many things are at play, as opposed to just taking a hard position and drawing a line in the sand.
Nice. All right. If you had the opportunity to travel back in time, what advice would you give your younger self?
I would say to my younger self, spend more time at the beginning building relationships, quality relationships. Don't spend money on anything that's unnecessary. Because I was definitely guilty of that when I was younger, just buying things that I did not need, whether it's trying to impress someone or just thinking that I had a little bit of money, so I should spend it. I would have focused more on saving. I would have focused more on trying to build quality relationships.
Great
I
advice.
love that. Awesome. Okay, Chad, what's the best investment you've ever made?
Becoming a partner in my firm is without question the best investment that I've made. It's I was able to invest in it, and I became a partner in 2014. And but with doing that, I also started having some more influence on growing it and shaping the future for it. And it's just been it's been financially rewarding, but it's also just been rewarding seeing helping develop people, other agents. We renovated our entire office recently, and it's just really exciting. It's really exciting to just think about the future of our office, and it wouldn't be there if I wouldn't have invested in that 2014.
That's
Amazing.
incredible. Building something great, right? Good.
Yep.
Now, what's the worst investment you've ever made, and what lessons did you learn from it?
Well, pretty much every stock that I think I have an insight or track on has turned out to be a bad investment. I've made so many bad investments in the stock market that I always think that I can see something that no one else sees, and then it just turns into be a flop. So it's really reinforced to me that either buy something that you know, which in my case is real estate, or just buy an index fund, where you don't even have to think about it. Because unless you're an expert in the stock market and prepared to devote an entire amount of your day to it, it's just really hard to actually outperform the market. And then I had one bad real estate investment that I made, but it learned a mistake from it, and it cost me a little bit of money, but it wasn't something that catastrophically affected my life. But it was making the wrong real estate decision can also be costly as well. So not just stocks, but any investment that you make a mistake on can be costly.
All right.
Who's it? I think there's a famous person, either Warren Buffett or someone else, says there are no bad investments. They're just bad investors. So
I like it.
Yeah.
Yes.
All right. How much would you need in the bank to retire today? What's your number?
I don't. Well, I will never retire. Actually, there is no number that would make me retire, because I genuinely just enjoy what I do. I love being on podcasts. Like I hope my like any energy that I have, I hope it comes through, because I really do love this. Like if I could jump on a podcast every day, I would, because I just like talking to like-minded people that have the same type of enthusiasm. So I love doing stuff like this. I love working at the office. I love working on deals. There's no amount of money that I would retire on, but I would certainly slow down. I wouldn't be working as hard as I am right now and spending the same time at the hours at the office. I think like a great number that I'd like to get to would be somewhere in like the 20 to $25 million range. I think that you can just live very comfortably off those dividends, and then you're leaving a really good nest egg for future generations or to donate at some point. 20 to 25 million would probably be my life goal.
Awesome.
absolutely.
Okay. If you could have dinner with someone dead or alive, who would it be?
Warren Buffett. That's just, speaking of that quote, Warren Buffett. I've watched the majority of things that he says at his AGMs, and the one just wrapped up this past week. I think he's such a fascinating human being, and there's nothing necessarily magical about him other than he's a really smart financial guy that was very patient. And I just love to bend his ear and hear some of the stories that he has of dealing with these hotshot brokers who all think that they had the answers for it, and he just came out ahead all the time. He's just a winner. For 90 years he's been a winner, so he'd be the first one.
Yeah, I don't invest in stocks. I invest in companies. So I love that quote by him.
Nice.
Yep, that's
All
a great quote.
Another one, if I can share about Warren Buffett: never invest in a business that you don't understand. That's another one.
Yes.
That's where syndication and limited partnerships and all of this stuff that comes into play that we have to educate our investors
Absolutely.
on, because it's difficult to raise capital when the investor doesn't fully understand what the heck it is. But my weekly newsletters help with that.
They do, August. All right, Chad, if you weren't doing what you're doing today, what would you be doing now? I know for sure it's not a residential realtor.
No, that's a good question. If I was smart enough, I probably would have went down the law school route, but I just didn't have the work ethic, and I don't think I would have passed the LSAT or the bar exam, so I never did go down that road. But I'd like to think that if I could buckle down for a while and really work hard, I would love to have had that law degree background. I've got a tremendous amount of respect for lawyers, even though we butt heads with them quite often. I've got a deep appreciation for their knowledge of an area which is very specialized. So that would be what I would do if I was going the education route. If I could choose to do anything, I'd probably want to be a venture capitalist. I'd love to hear and invest in startup companies or companies that need seed capital or doing their Series A. I'd love to be investing in that. And at some point, I probably will try to add that to my investment portfolio.
Absolutely.
Okay, really cool. Okay, my favorite question: Booksmarts or Street Smarts?
I would say both. And I know that's a cop out of an answer, but I really do believe that you do need both, and probably in balanced proportion, because someone can have street smarts, but if they don't understand the theory or the academics behind it, I think that it's only going to take them so far. And book smarts doesn't necessarily even need to be formal education. I think book smarts can be reading a really good book written by a successful real estate investor who's already done this. That to me, I'd classify that under book smarts, and that just takes extra effort versus going out and doing it. I would be very reticent to to invest myself if someone wasn't combining both of them. I don't want someone that is just fresh out of having a PhD in business. I don't think that's going to serve anyone really well. And I don't necessarily want someone that's just a gunslinger and going out and just trying to learn trial by fire. I think that there has to be some balance. So I'd want both.
Okay, right
Got
on.
it. Unless the gunslinger brings on PhDs to be part of the company. So.
Yeah. Well, he might be the smartest one of all then.
Awesome. Okay, last question. If you had $1 million cash and you had to make one investment today, like literally today, what would it be?
It's a very specific question, Chad, but you're a bright guy, you're a sharp guy. So let's kind of go over this one more time. You got $1 million cash, it's liquid, all right? You can make one investment and you have to do it today. The markets are closed, so it's unfair to say today, but let's say in the next couple days or 24 hours, you got to make one in, but you got to deploy all of that. What would you do?
Yeah, my natural inclination would say to park it in real estate, but I also I'm a big believer that real estate due diligence takes time. Like I wouldn't want to make a decision with like that time deadline on it. I always recommend to people is like, make sure you spend the time to do your due diligence. So instead of saying real estate, which if you would have said 3 months, I would have said I would have found a great warehouse deal either in my market or in a market like Corpus Christi. That's where I would have said in 3 months. With 1 day, I'd park it in cash. Maybe park it in an area where I can earn 1% on it and be able to access it on moment's notice. And then maybe I'd take that $1 million that's invested in that term deposit, and then I turn it into a warehouse deal in 3 months.
Awesome. This is you got to love it because he's transparent and honest. You know, even though that his asset class, he still says that, and he's risk averse. So hey man, we really appreciate you being here today. Maybe last question is, what is the best way people can reach you? Say this for the audio version eventually when it gets on podcast.
Yeah, email. I always try to reply to my email every day. It's griffithscre@gmail.com, or check out my YouTube channel. I talk about warehouse space nonstop. I like to pride myself that I never mention what city I live in, and I don't even mention what company I work in. Really just try to provide as much information as I can.
Yeah, you've provided so much value to myself, I know to August and to our listeners. So thank you so much for being here today. We really, really appreciate you.
Well, you guys are great hosts. Thank you so much for the thoughtful questions. And that was I loved it. I like I said earlier, I love doing podcasts. And when you guys are as awesome and as professional as you are, it makes my job even more fun.
Well, you're the best guest. So thank you so much.
Thank you very much.